India's HDFC Bank surpasses expectations, but margins remain a concern, a surprising profit boost. In a surprising turn of events, HDFC Bank, one of India's leading private lenders, has reported a significant profit boost for the second quarter of 2025. The bank's logo, a symbol of financial prowess, shines brightly as it defies expectations, leaving analysts and investors intrigued. On October 18th, HDFC Bank revealed a standalone net profit of a staggering 186.4 billion Indian rupees, $2.12 billion for the quarter ending in September. This figure surpasses the estimated 177.18 billion rupees, according to LSEG data, and marks a notable increase from the 168.21 billion rupees earned in the same period last year. But here's where it gets interesting. This success comes despite weak lending margins, a factor that typically impacts profits. The bank's net interest income rose by 4.8% to 315.5 billion rupees, yet the net interest margin contracted to 3.27%, down from 3.35% in the previous quarter. This contraction is a common occurrence when banks adjust their loan books to reflect policy rate changes, but it usually affects profits. The margin mystery, HDFC Bank's chief financial officer, Srinivasan Vaidyanathan, offered reassurance during a conference call, stating that margins will improve in the upcoming quarters as deposits reprice. This prediction hints at a strategic plan to enhance profitability, but it also raises questions about the current state of the bank's lending practices and the factors influencing these margins. Net trading and mark-to-market gains for the quarter stood at 23.9 billion rupees, a substantial increase from the 2.9 billion rupees in the corresponding quarter last year. This growth is a positive sign, but it doesn't fully explain the bank's overall performance. Loan growth and economic recovery. HDFC Bank's loan portfolio expanded by 9.9% year-over-year, fueled by increased lending to small and mid-sized businesses. This growth is a testament to the bank's resilience and the improving economic climate in India. The bank's merger with its parent company, HDFC, 2 years ago, has also contributed to a 12% on-year growth in deposits, strengthening its financial position. Indian lenders have experienced a gradual resurgence in credit demand after a period of slowdown. Analysts anticipate a more robust recovery in the second half of the fiscal year, aided by recent tax cuts. HDFC Bank's CEO, Sashidhar Jagdishan, noted that economic activity has visibly increased following these tax reductions, positively impacting the bank's loan growth. Looking ahead, growth and controversies, HDFC Bank aims to expand its loan book in line with the broader banking system this financial year and accelerate growth next year. This ambitious goal is supported by improved asset quality, with the gross non-performing asset ratio decreasing to 1.24% in September, from 1.4% 3 months prior. However, the bank has increased its provisions for potential bad loans and other losses by 29.6% over the last year, reaching 35 billion rupees. This move, while prudent, raises questions about the overall health of the banking sector and the potential risks associated with retail lending. Indian banks have tightened underwriting norms and allocated more funds for loan loss provisions, particularly in personal loans and credit cards, indicating a cautious approach to retail lending. As HDFC Bank navigates this financial landscape, it leaves us with intriguing questions. How will the bank maintain its growth trajectory while managing these challenges? And what does this mean for the broader Indian banking sector? Share your thoughts and insights in the comments below, and let's explore these fascinating developments further.